Good day, and thank you for joining Tyler Duncan Realty Partners monthly podcast on this Wednesday, April 30th, 2025. My name is Chad Tyler, and I'm here with my colleagues, my partner Brian Duncan, and our colleague Charles Shapiro. Brian, you want to say hi?
Hello, how's everyone today?
Mr. Shapiro, say hi to everybody.
Hey everyone, good afternoon or morning, wherever you are.
Great to be with you guys. So today we're going to cover a first quarter update on the Washington D.C. market. We're going to cover the residential market for the Washington D.C. and extended metropolitan area, along with certain commercial sectors. We're going to cover the office market. And we're also going to cover the industrial market and the retail market. And then we're going to cover the office market, retail market, and industrial market for Denver as well. So those are the two markets that we're most active in, and we want to share the first quarter stats with you and sort of trends and key takeaways from what we're seeing from the first quarter. So with that, Brian, I'm going to have you start off on the residential sector for Washington, D.C. So take it away.
Sounds good. Thanks, Chad. Let's go to the next slide. So it's been an interesting 3 months for various reasons. The Washington metro residential real estate market slowed to some degree, but not in all levels. For instance, luxury homes, not only in price, but in demand has increased significantly. Anything over 1.3 million, the demand is very high. However, for instance, Prince George's County experienced a decline of 19.7% sales in March. However, April looks like a rebound month as they have more pending sales ever than they've ever had. Overall, home prices were rising slightly. We'll talk about that a little bit more. And then what's also interesting is there's a significant increase in inventory, particularly from new construction. New construction has a higher price point at this point because of scarcity of land in our region, government regulations, and construction costs. So, however, home demand, the index has increased from 77 to 92%. Now, isn't that interesting, thinking about everything that's going on in our industry? But some of the interesting parts of what we're seeing is price reductions. It's not a significantly large price reduction. However, if the inventory continues to increase, you're going to see probably what we call a neutral market. It's currently still somewhat of a seller's market throughout the region, except for maybe in Prince George's County, Montgomery County, larger parts of larger communities of the DC metropolitan area. Economic uncertainty, well, I think we all know what's going on. In March, it really did impact. However, April seems to be coming back in a big way. And it's not, of course, government employees. We have a much larger housing demand from private employees. So if we look at just Maryland statistics, yeah, we had a decline by 10%, the aforementioned 19% in Prince George's County. Pricing went up, sales pricing went up, which is a good thing still. The units, this is really what it appears to be really good. Under contract, 6,621, which means April's going to be a rebound for the lower sale volume than in March. The average days in sales, haven't really significantly increased. And the months on the market, the inventory is still low. Just this week, we had the state of Maryland through the Community Housing and Development report that there were 149,000 housing units short in Maryland alone. Next slide. I think that's it for residential.
On the residential side, I know there was, some hope, maybe expectations that interest rates would be trailing down. They really haven't. So, how are you seeing interest rates nowadays playing into the market in terms of buyer demand? Is it affecting it that much?
It's actually affecting it in a positive way. We're down to 6.39 on a 30-year fixed mortgage and a 5 mid-range, 5.5, 5.4 on a 15-year fixed right now. So I think that's partially bringing people back to the market in April.
Brian, why do you see the higher end of the market being so stable and strong?
That's an interesting thing. But, I think nationally, we also have to be cognizant of the fact that more and more houses are now selling for $1 million than ever in the history of. Okay, so that's part of the dichotomy of that.
And I know as of right now, it doesn't seem that with some of the federal layoffs have played in a big way into the market. Any sense of what the expectation is or what you're thinking? Like,
Well, we have in Montgomery County, that's a good question. In Montgomery County, we've seen an increase in listings, and we really think it's government employee driven. We don't think it's necessarily government contractor driven. If that happens, if those contracts diminish, then we're going to see a serious issue with oversaturation. But right now, it's not an issue. We've weathered this storm before. We'll probably have to weather another one.
Gotcha. So, Charles, before we jump into the Washington, D.C. office market, any other questions for Brian or comments on the Washington, D.C. residential market?
No, I think this quarter is going to be an absolutely fascinating one in the residential markets. So it'll be very interesting to come back next quarter and see what's going on.
Yeah, absolutely. All right, so let's move into our Washington, D.C. office market, and we're going to start off talking about absorption and also vacancy rate. So on our first graph here, the green line represents vacancy rate up around 18%. And then the blue bars represent net deliveries, trailing net deliveries and through the first quarter of 2025. And then the orange bars represent net absorption. So right now, for the first quarter in the Washington, D.C. market, we're still seeing negative absorption in the office market. And by contrast, if we look at all the major metropolitan markets across the country, actually more than 50%, approximately 52% have all turned positive in terms of absorption. It's not reflected in the graphics here, but going back to our prior slide, as I said, we're showing negative net absorption for the first quarter for Washington, D.C. And that's despite about 1.7 million square feet of leases that got done. We just have more space brought to the market. So the positive side of it is, if you look at the graph, you can see that the negative absorption is trailing down. So we're kind of at an inflection point where we think maybe over the next 2 quarters we'll get to positive absorption. Going to our next slide, looking at the availability rate. So we're showing an availability rate of 23.5%, so higher than the vacancy rate. We've talked about this in prior slides, but the difference between the two is that the availability rate takes into consideration sublet space. So it's space that might be technically under lease, but the tenant's trying to lease it. So that inevitably adds to the vacancy. So looking at year over year in terms of the availability rate, it's about almost 1% higher year over year from what we saw last year at this time. And as I mentioned earlier, we even though we saw 1.7 million approximately square feet of leasing during the first quarter, we still had more space come to market, which created the negative absorption. So, and I'd like to, and we've talked about some of the potential impact of the federal policies and the GSA and the government, pulling back from the market, giving up space. That's definitely played into the dynamics in the first quarter, not in a big way, but it's expected to play a bigger role throughout the year. So going to our next slide showing rental rates. We've got rental rates right now for Class A 5-star type office buildings. They're at $58.50 a square foot. We look at the blended average for those properties that are 4 and 5-star properties. Asking rate is about $47 a square foot. But it really hasn't changed much over the last year or so. It's been fairly steady in terms of the asking rate. We go to our next slide. That shows rental rates on an inflation-adjusted basis. So we all know that for the last few years, inflation has been high, and this just shows the rates adjusted for inflation. And in fact, it shows the rates trending down after inflation adjustment, at least as far as the asking rates. We look at our new construction on the next slide. You can see, not surprisingly, with Obviously, the market being extremely soft, we're looking at significant reductions in construction. So for the first quarter, we're looking at about 400,000 square feet delivered in terms of new construction. 50% or greater of that was pre-leased, not surprisingly. And so that trend is gonna hold for the next few quarters. We're just not going to see much being delivered in the way of any new space, and what is delivered is certainly most likely going to be pre-leased. So if we go to the next slide, which shows our sales activity, we can see that sales activity trailed off quite a bit, not surprisingly, for the first quarter of this year, at a volume of about $738 million. And again, not surprisingly, a lot of that was distressed activity as far as the sales that were occurring. And that's a downward trend of about almost 50%, 47.3% from the previous quarter. And I'd also add that right now, going into 2025, it's estimated there's about $51.6 billion in distressed debt in the marketplace tied to office property. So that's going to be a continued slow rollout of a lot more distressed sales over the next year, and really over the next couple of years. So with that, before we jump into the Denver office market that Charles is going to speak to, Charles or Brian, any comments or questions about the Washington D.C. office market?
Well, it's very interesting. First off, the office market and the retail markets, when you look at Denver and you look at Washington, if you threw graphs up, they look basically the same. These markets are so similar for different reasons. But what I really want to ask about is when Donald Trump came into office, what the market saw was, okay, he's going to cut taxes, he's going to cut regulation, and he's going to make sure government workers go back to the office. And that was going to be good for business, obviously, because you have a lot of businesses that have depended upon these workers, and now they're going to come back. And all of a sudden, that's been yanked from them because now you're cutting and slashing workers. So the question is how long is the market really going to recover that quickly, or is it going to get another sort of punch in the head because we have people that are being fired or cut?
Yeah, I mean, I'll just make a couple comments on that. And certainly, Brian, if you have some or other questions, chime in. But there definitely has been, even though there's been some cutting in the federal workforce, there has been some return of personnel back to the offices, which I think it has been helpful. It has been productive. But having said that, again, I think the bigger bulk of the impact of GSA and federal cutbacks in terms of the amount of space they're taking or what they're going to vacate, that's really going to be in the future, somewhat near term, but really over the next year and 18 months and couple of years. They have, in the first quarter, they pulled back with some space, canceled some leases, but there's a lot more of that to come. So I think right now we just have not seen a big impact either way in terms of federal employees returning to the office in conjunction with the space that has been given up so far. Brian, any thoughts or comments?
Sure. What's interesting to me is the amount of distressed properties that are still out there and the more we're hearing about. So I think that's going to have a negative drag. And also, from what I've heard, is that foreign investment in commercial real estate is waning. I think we have to figure that as a negative as well.
Absolutely. No, those are great points. All right, with that, why don't we shift gears? And Charles, why don't you fill us in on the Denver office market?
Very good. Yeah, as I said earlier, the comparison between DC and Denver is really striking. I mean, right now, so we can go to the next slide, and then there we go. If you look at the vacancy rate in Denver and DC, both the same, are really around 17.5% of large markets around the country. These are amongst the highest in the country. And where we see DC may be a bit of an inflection point, we're not seeing that yet. Maybe going into next year, we're going to see some balance between the supply brought onto the market and the demand. But right now, we're still seeing a lot of negative absorption that really hasn't gotten a whole lot better. So we don't think that vacancies are going to go that much higher, but they're probably going to go into around the 18% area. Next slide. So in terms of leasing activity, I mean, this is looking at the last 5 years. So, really, if we think that the average quarter is going to be, 2.25 million square feet, you can see the decreases over the last 5 quarters. Every quarter, the lease activity has gone down and down and down. And so it's really been on an average flat since 2021. What we're seeing on the market, though, is we are going to be seeing more leasing activity, but not in terms of actual leases. What we're seeing is when a company has to renew their lease, they're not necessarily renewing their lease, they're moving. But they're moving from 15,000 square feet to 8,000 square feet in a much higher quality building. So they're moving from the smaller spaces in Class A buildings to higher quality Class AA buildings because they want their people to come back to the office, but they're realistic about the fact that they probably won't. Denver, by the way, the influences on Denver is that we are a big tech market out here, and tech workers can work from home. And the tech market isn't going to stop them. They like their workers, they're home, and they're probably going to stay that way. So we don't see these dynamics changing. We'll call this the COVID effect, where some markets will see some changes, probably not so much in Denver. Next. So office rents. Now this is very much, look at these lines going back 5 years. They're basically a straight line going up a little bit. These are the average rents. So that top line is 4 and 5 star properties, where in DC it's, in the 40s and 50s. Here it's in, the mid 30s for those high rents on a triple net basis. But we're not seeing much movement. We don't expect to see much movement. Basically, they're the same as 2020, but real rents, the rents that you get after you take away for tenant improvements and free rents and all that, are way, way down, because obviously these developers are being very aggressive in getting the tenants that are out there into their buildings. Sublease space is also becoming a major competitor for prime space because they will advertise at lower prices, whereas the major buildings don't want to advertise lower prices. They'll discount, but they don't want to show lower prices. And in this market, Cherry Creek is really the only landlord-friendly submarket. It's tight. Buildings that get built there are filled up quickly. It's a very strong market. That shouldn't change anytime soon. Now, in the next graph, we're seeing, again, the inflation-adjusted rents. And Chad and I decided to put this in here to let everyone understand that if you don't see any changes in rents, you're losing ground, and you're losing ground bad. And you can see at the very beginning of that graph where it's flat. And then you see where inflation started kicking in, and all of a sudden these real rents are going down. So landlords are hurting. Next slide. So under construction properties. Now, we actually have 1.7 million square feet still under construction. Only 40% of it is pre-lease. That's a big concern. How long is it going to take to lease up the rest of that space? But also, like Chad was talking about in DC, you're not seeing new stuff go up. The last time ground was broken on a new building was 2 years ago. And we're not expecting anything in the near future until this market stabilizes and we start seeing lower vacancies. Next. Sales activity. Again, this is one that you can just put DC and Denver on the same graph. It looks exactly the same. The prices per square foot are coming down. We expect it's going to flatten out. We're not going to see prices go down too much. Most of the sales that you're seeing are single tenant buildings that, we're working with some tenants, some companies right now looking for their own property, but they're also seeing aggressive deals out there. And you can just see the number of sale deals. In the last 12 months, we've had $1 billion in sales, which are 2010 levels. Cap rates are shooting up. I didn't think that we were going to see close to 10% cap rates on the office market, but here we are. And they've gone up a great deal in the last 4 years. And just like DC, a lot of the distressed office properties are probably going to come up and hit the market in the next year. So, you're probably going to see prices per square foot come down a little bit just because of those those properties. But that's what you need to clear out the market. You got to get rid of these distressed properties. We need to see vacancies come down and rental rates start to tick back up. So, guys, any thoughts about the Denver market?
Yeah, Charles, just a couple questions. One of which is, I know pre-pandemic, the Denver market, the office market specifically, was successful in attracting some corporate relocations into Denver from other states. And that was driven by a growing younger workforce, also quality of life issues and other similar related factors. How do you see that playing into the market in terms of potentially helping with some kind of a rebound, or what are your thoughts on that?
And that's what we're looking at, these new buildings with all that vacancy, because Denver is an attractive market. People do come out here because of the quality of life, and you are seeing deals come out here. They're just smaller deals. You're not seeing 250,000 square foot deals. You're seeing the 250,000 square foot deal is now 80,000 square feet. So you're seeing smaller deals, and businesses right now, especially with the tariffs, I don't think you're going to see much over the next quarter or so. I think a lot of people are going to take a wait and see attitude. How does the tariffs impact their business? Certainly in downtown Denver, they're still not seeing companies returning to the office. You're still at 60% of total workforce that is back at the office. 40% are still working from home. So it's going to be a challenge. It's going to be a challenge. I think every market is looking to get the steal a tenant from another market. And Denver's certainly well placed to be able to do that.
Yeah, Brian. Before we move on to the Washington D.C. industrial sector that I'll cover, any comments, questions?
Yeah, question here for Charles. Charles, so with the distressed commercial properties there, have you seen any of the adaptive reuse conversions into housing?
A few. There have been one or two. They are really looking at it. The challenge is that many of the buildings simply do not, they don't work for apartments. I mean, you need to see sort of shallow, floor plates so that you get window line. And when you get these big square buildings, it's really, really difficult to put an apartment in there, and also, the AC units that are required for the building. So it's a little bit easier in some of these downtown D.C. buildings than it is in Denver to do that.
Okay, makes sense.
So we're going to move on to the Washington, D.C. and extended metropolitan area industrial sector. And similar to the graphs we shared for the office market, we're going to start off with net absorption, net deliveries, and vacancy. So overall, the Washington, D.C. and extended metropolitan area, as far as the industrial sector, remains very healthy, very strong. Vacancy rates have increased a little bit. So right now we're up to a vacancy rate of 6.75%. And that compares to a national average of about 7.25%. So the Washington, D.C. market is faring better in that regard. During the first quarter, we saw deliveries of about 1,750,000 square feet. A fair amount of that is data center space and other specialized space. And we saw net absorption down a little bit during the first quarter, year over year, with approximately about a 1% decline year over year. Going to our next slide, looking at vacancy rates per building type, you can see that on this chart, we've got the orange line that represents specialized space types, which would include data centers, things of that nature. And then blue shows logistics type space, bulk distribution type space, green being flex, and then the yellow is overall. And the vacancy rates are actually fairly tight, close together for each product type. I mean, generally speaking, they range from about 6 to 7%, and still low compared to the national average, and healthy vacancy rates. Going to our next slide, looking at net absorption. So we saw negative net absorption for the first quarter, which is certainly bucks the trend from the last few years. but not too large in terms of the amount, about 290,000 feet to the negative. And then given what was delivered to the market, 14.9% was pre-leased. And then we saw net deliveries about 596,000, in round numbers, 597,000 square feet. Looking at market rents, you can see just over the last few years, rents for each product type has just steadily increased for the last several years, and that trend continued into the first quarter. And depending upon the product type, we see on the low end asking rents at $16 a foot, and then up to a high rent of like $20 a foot. At $20 a foot, that reflects mainly like flex type space, which not surprisingly is on the higher end. Sometimes you get pure warehouse with a flex type space, or some level of office within that type of space, some office component. So moving on to the next slide. Again, this shows the inflation adjusted rents. So contrary to what we saw with the office market, where the inflation adjusted rents were trending down fairly significantly, they're still trending up modestly with regards to warehouse in the industrial, different types of space. And then under construction, so right now in the first quarter of 2025, at about 2 million, a little over 2 million square feet under construction, fairly consistent with the last couple of years. And again, some of that was pre-leased, but fair amount not. Just shows the optimism within the Washington, D.C., the extended metropolitan area for the industrial sector. Then going to our final slide showing sales activity. Consistent with what we've covered in the last few quarters, the sales activity in the industrial sector has been pretty modest. And that's largely just because there's really not a lot of sellers. It's such a strong asset type that it's just not, owners are just not motivated to sell. The pricing has gotten considerably high for the product that is being sold. So like right now, the average price per foot is about $260 a foot during the last quarter of what has sold. So again, overall, it remains a very healthy market for the Washington, D.C., and extended metropolitan area for all the different industrial components. So before we jump into Denver, Brian, any comments, thoughts, or questions about the industrial sector for Washington, D.C.?
So, as you know, we spend most of our time on discussing data centers in this region anymore. Some warehouse distribution up in the Washington County area, but for the most part, it's data center, which is a higher price point they're paying per land. And I guess it will ultimately impact, like you said, it's such a great asset to retain. So I'll probably see even less of it sold and more of it just enter into the rental market as some of these individual sole proprietor businesses sit and mature in their own, own facility. They'll probably want to rent it out.
No doubt about it. No doubt about it. Yeah, but the data centers have played a huge part in the marketplace, particularly in Northern Virginia. But that's starting in Maryland is starting to play a bigger role, and a lot of where the larger vacancy is right now is with the big bulk distribution type properties, where people have gotten a little bit ahead of the market. But long term, it's still great. There's going to be a demand and need there. Charles, how about any thoughts about the Washington, D.C. Industrial market before you talk about Denver?
Well, where your office is at, Frederick County, going into Rockville, my assumption is, knowing the area, you have smaller bay warehouse, and it would seem to me that stuff is pretty tight and the rental rates are probably pretty high. So can you tell us about some of those smaller bays?
Yeah, I mean, you're absolutely right. I mean, they're extremely hard to find, and the rates are high. I mean, generally in the for older type of product, in the $15 triple net range is where we're seeing rates. Just on the smaller scale within the last couple of months, we listed a small industrial condo in the Gaithersburg market around the sub-market around the airport. And we had it under contract within a week. And
I
we
think
probably
he's being modest. It was 10 minutes. It was 10 minutes.
But we probably had 25 or 30 different calls from
Right.
direct buyers, other brokers within a span of 2 or 3 weeks. So it just shows the lack of inventory and the demand from the smaller users of really all kinds of different types.
And there just isn't the base land for that to be developed. That's the problem.
Yeah. I mean, Montgomery County in particular is constrained, and Frederick County, they're getting more aggressive in terms of trying to zone more land. Washington County, there's probably adequate amount, but there's a little bit less demand there. And you look at other counties like Howard, it's limited land there, Anne Arundel. So yeah, it's going to be a tight market for a while. So
Right.
why don't we switch gears, Charles? Why don't you talk about the Denver industrial market?
Well, this is going to be fun because it's the one market type where the markets are very, very different. So looking at this graph, the first thing I want to look at are the new deliveries, which are the blue lines. And you can see that, we have fewer and fewer deliveries going into the future. Very important in what's going on in the marketplace because we have higher vacancies than we normally have. As you can see, we're up in that 8.5% area, which is higher than normal and higher than investors really want to see. Also, we're seeing deals are taking a little bit longer to complete. They are being more complex. I think that they're seeing deals being done in the office market. They say, why can't we get more free rent? Why can't we get more TIs? So they are being more aggressive. And also, when you're looking at activity, where is most of it's coming? It's coming in the East I-70 corridor area around the airport where you can really build big base space where you could do 100, 200,000, 300,000 square feet, and actually over 1 million square feet, which we'll talk about in a deal in a moment. So moving on. Okay, leasing activity. So, we're looking at sort of this average of around, 3.5 million square feet, and leasing activity has been down and it's slowed down a little bit. But we are seeing a more of a matchup between leasing activity and delivery of new space, which means that we do expect that vacancies will start tipping down, but it sure be nice to make sure that every quarter that leasing activity is between 3.5 and 4 million square feet. That's what we would like to see. And obviously, this quarter, it's too early to tell what the activity might be going forward. Rental rates. Yeah, so it's really interesting. I mean, this is going back 5 years, but if I had pulled this back to 10 years, you would have seen 2014, the rental rates will start shooting up. So rental rates have been stable. They have not been growing at the 6.8% level that it's been over the last 5 years. Actually pre-pandemic was 6.8%. So it's slowed a bit. The lowest rents are in the largest distribution spaces, especially if it's 24-foot clear height, which is what was being built 20 years ago. You can get those for $7 a square foot, but if it's 30 feet and higher, you're going to see $10 a type space. And certainly for smaller space and flex space, that's going to go up in the 10, 11, 12, up to $15 square foot. The expectation, though, is that we're going to see rents start to grow as some of the space that's hitting the market gets leased up. And that's the expectation, that we're going to start seeing more rent growth coming on in the next, later on this year. So looking at the real rental rates, certainly not like office where it's coming down, but we still see that in the last year or so that that inflation is taking a big bite out of any increases that we're seeing in rental rates. New construction. So we were talking earlier that construction is, by the way, falling, number one, because developers do see that the market has too much space, but also it's difficult to get financing. It's difficult to get financing, and certainly cheap financing anywhere. So most new construction is in the build-to-suit area, and we were talking earlier about the large leases, Pepsi is, building their own facility at 1.2 million square feet that's set to open sometime this year. I think it is their largest manufacturing facility in the country, but it's still not, we do need the construction to come down and stay calm for a year or so we can get those vacancy rates down. And that leads right into the sales activity. So we're seeing sales activity like every other property type. It's about 30% lower than the 10-year average. One of the things that we're expecting is that sales are going to pick up once vacancy rates come down. I think investors want to see these vacancies cut before they start investing in the marketplace. They want to see more leasing activity, and they've seen things quiet down. I do think this is part of the business cycle. It's not something like what we're seeing in office and retail where there are real long-term problems. These are short-term. People are still buying. People are still warehousing product. You're seeing Amazon build facilities, Walmart build facilities. So, there's still a demand for them. So we see the industrial market stabilizing. There'll be a slowdown in construction. This is where construction at its lowest level since 2017. And the other thing, when we're talking about in Maryland, small bays, and specifically lower than 50,000 square feet, but there's 10, 15, 20,000 square feet. That's where you're going to see the action. And you'll see action with private investors that see opportunities in the small bay area, which is still active. So guys, any thoughts?
Charles, it seems that with the industrial market in Denver having softened some, that maybe there's more opportunities coming to market, particularly with some older buildings, older warehouse buildings, for owner users to buy. I know, going into maybe like early 2024, mid-year 2024, it's still a very tight market, limited product for owner users to buy, pretty high pricing on a per square foot basis. What's your sense of that? Are you seeing maybe some more opportunities come to the market for?
Well, it's interesting because just Pepsi just built 1.2 million square feet, and I think that you're going to see a lot of owners look very carefully at the cost of leasing versus owning long term. I just think that's going to happen with an expectation that this is the one market where you are going to see appreciating properties out there. We're not going to see it in office for a while. And we haven't talked about retail yet, but retail is going to be tough. So I do think that you're going to start seeing more activity in the owner user market. You and I have seen some properties out there that would fit really well for an owner user. So I think you're going to see more of that out there.
Interesting. Brian, before you talk about the Washington, D.C. retail market, any other thoughts, comments, questions about the Denver industrial market?
No, I think it mirrors everything else going on in the country. It's that smaller bay. I think it's where the next level of investments is just not as sexy and it's plentiful, but it's coming again. So.
And they're not $100 million sales. They're
$3
million sales, the $5 million sales.
Same amount of work, though. Same amount of work.
Yeah, absolutely.
So, Brian, why don't you give us a rundown on the Washington, D.C. and metropolitan area?
Yeah, it's been an interesting couple of weeks here in D.C. on retail. We like to say the fundamentals are strong, but last week the D.C. region was shocked to find out that the largest suburban mall, the fourth largest DC metro mall, 1.6 million square feet, defaulted on a $235 million loan. So what we're seeing is planned urban development, transportation, overlay district, retail space kind of being built, very specific to suburban and downtown DC retail space being built. But it's a little different than the malls of the past, the Walmarts, those big boxes. We're seeing not as much of that. And to this point, it's less than 1 million square feet kind of a space. The absorption is low because, there's not a lot of space to begin with. And the market here is driven by a couple of different factors. You have growth and it's a desirable location. There is a lot of wealth here. So people are still shopping. They're still restaurant experiencing. Although 2 weeks ago, we had a survey come out and said that 44% of all restaurants in DC felt that they could be out of business within a year. And part of that was due to what Charles alluded to earlier, that they don't really see as many people coming back to the office as had been hoped. Next slide, please. So what you see here is leasing activity. You can see it's flattened quite a bit. I think past that, there's nothing else that you can say about that slide. So the rental rates are the interesting part of this whole thing. We're seeing ranges of 30, 40, and in some cases as high as $56 in some of these newer shopping areas. They're not traditional malls, they're not traditional shopping centers. Some of them are just very 6,000 to 12,000 square feet spaces. Some of them are 40,000, but they're broken up into spaces of less than 2,400 each. And it's affordable space. And we've seen this increase over the last 5 years. We don't expect it to slow down. So here's the construction, the first quarter uptick in construction. I think it's a good point here that after declining construction, they're seeing some need for additional construction. You're seeing chains come in, building one-offs. You're seeing rising construction costs and rising land costs hurt the construction industry portion of this. However, the demand is still there because the houses are still being built. The apartment complexes are still being built. Most of the apartment complexes have 1 or 2 floors of retail space associated with them. So that number is factored into here. So then if you look at sales volume, I don't think this is going to surprise anybody, especially if your major malls are defaulting. Sales of the actual strip centers or small centers have declined. We know from a very personal level that, however, most of these spaces don't have a real high vacancy rate. So why would you sell it if it's really garnering you rental rates and if you bought it at the right cap rate? Next slide. There you go. Chad, do you want to do Denver or Charlie?
Denver.
Well, any comments, Charles? Comments, questions about the Washington D.C.
Yeah,
retail market?
it's very interesting because hearing about the default of a major center. Unless you are, I don't know what center we're talking about.
Wheaton.
Oh, Wheaton. Yeah, you're not talking about a major wow center, Pentagon City, which is going to be fine. But I think, here, Cherry Creek, it's going to be fine. But there's like only 1, 2, or 3 in the area that are going to be fine. And after that, if you're not in a Class A area, it's going to be difficult. The other thing that I think is difficult is restaurants. Restaurants, especially at a lower price point, they can't afford $30, $40, $50 a square foot. Just can't do it. And I think that's a constraint. I think that's what we're seeing in the Denver market. We're seeing constraint on rents due to the fact that some of these tenants just can't pay more and the landlords know it. So let's keep these guys in there at lower rents and let's keep the cash flowing rather than pushing a tenant out that's paying my rent and maybe lower than I'd like, but still paying the rent.
Why don't you go ahead and speak to the Denver retail market, Charles?
Gotcha. Again, just like DC, very, very little vacancy over here. It's really very difficult for tenants to find space. You can see over here just in terms of absorption, the orange lines, we've had more positive absorption than negative absorption. That's keeping the vacancies very, very low. As I just said, there's very little space to lease. And what we're having, where you're seeing the competition is for land, build-to-suit land in well-located areas, because that's where the national tenants are competing, and that's the leases that are getting done in standalone build-to-suits. In just my community, we're seeing standalone build-to-suits, and it's all national tenants that are doing it. The downtown markets, they're having huge problems. There's low foot activity. There's concerns about safety. These have been ongoing concerns that I know the mayor in Denver has been working on, but it's really tough if you're downtown. And so, that constrains things a bit. But again, we don't have a whole lot of vacancy. Now, it's interesting because I was looking at DC and seeing, okay, what was their average leasing activity a quarter? And it seemed to be about 1 million square feet. Okay, Denver's here at around 800,000 square feet, but you can see, through 23 and 24, the numbers going down. Well, the numbers going down is because there's not lots of spaces to lease out there. It's very, very difficult to find spaces. Next. So rents, just like DC, they're going up. The last 12 months, rents have gone up by 2.6%. And as I said earlier, the main challenge is that owners know that local restaurateurs and local retailers can't afford high rents. So we're seeing constraints on rental gains there. Downtown rents are going down, but Cherry Creek, just like office, that is still a high quality market. You are seeing successful retailers there. That's where the restaurateurs are going. You're seeing high rents, or you're seeing rents in the 40s and 50s there. It's the Chevy Chase of Denver, and I don't think that's an exaggeration. Next. So under construction, and as you can see, we're talking about 380,000 square feet under construction. That's nothing. When we hear about a shopping center with 2 million square feet, 380,000 square feet simply means that you're doing build to suits and very small little neighborhood stuff. Again, my neighborhood, we're seeing neighborhood oriented retail. The construction activity is 0.2% of the inventory, and the vast majority is pre-leased because, they're build to suits. And this goes back to sales. So sales are going to be constrained. They're going to be constrained by financing problems. They're going to be constrained by the fact that there's not a lot of growth. Investors aren't seeing growth in these products. So why am I going to pay a low cap rate? Like you would see apartments where the cap rates were 4.5%, but they were figuring in rent gains. That well, over the next 10 years, we can raise the rents by this amount, and this is going to turn into a much bigger return. You're simply not seeing that. So as we said earlier, you're not seeing major national investors. You're seeing small investors. 80% of the sales transactions are small investors buying triple net properties, meaning they have a standalone Starbucks and the person buys it and they're buying it simply for the cash flow, and that's it. So we're seeing very few large sales over $5 million. You're seeing almost nothing. And again, as I said earlier, high interest rates, the uncertainty in the future of shopping malls and shopping habits are contributing to the problem. So like we were seeing in office, where there's so much uncertainty, there's still uncertainty is what will people go out to buy and what won't they buy? I've gone to the mall the last few weeks to get an iPhone fixed up over at the Apple store. The Apple store was pretty busy, but the mall, it was crickets. Now, yeah, we're talking, April here, but you're just not seeing activity. I think I'm going to go to some of the malls during the holiday seasons just to see what happens. So the key takeaways: availability is historically low here and in DC. It's difficult for tenants to find space. The construction pipeline is low because no one's building shopping malls and no one's building big shopping centers. We would expect rent growth to be higher than it is, but frankly, a lot of owners don't want to push it, and they don't want to push tenants out of their centers. So guys, any thoughts about Denver retail, or in conclusion?
That's a great overview. I would just add, you mentioned the very limited construction going on right now in the marketplace. And I know that there's a pretty big mixed-use project that's going to get underway next to Ball Arena, which I think has a pretty decent retail component to it. So that will add to some of the inventory. It's a great location. I'm sure a lot of that will be pre-lease. But yeah, other than that, that's in terms of new construction, that's one that comes to mind, but not a lot of other major projects. Brian, before we wrap it up, any other questions, comments regarding the Denver retail market?
No, I think if you guys are like me, I've already had 3 deliveries from Amazon today. Okay. Leave it there. Okay.
There you go.
I'm not exaggerating.
Exactly.
You said something really important there that I want to expand on a little bit. So what retail could be built? And it's like, again, my neighborhood, I live in an area called Candelas, and what's being built? There's an O'Reilly Autos parts being built. There's Jimmy John's. There's basically local retailers that they have research departments that knows that basically that, if the numbers fit, we can do business here. And that's it. So we're not going to see anything exciting. We're going to see Dunkin' Donuts. I mean, I am not.
Hey, that's exciting.
I know. I mean, so we have our Starbucks, we have our Dunkin' Donuts, we have the O'Reilly Auto Parts, Jimmy John's, anything else opening up. I mean, there's a few other, but there's nothing there that gets you excited. There's nothing there that's new or vibrant in the area, but it's all built because there's enough houses being built to justify it. But you're not seeing anything big, no big shopping centers, or certainly no malls.
Great points. Great points. Well, we'll wrap it up there. As always, we really appreciate you joining us for this month's podcast. If you have any questions we did not address or any more information you might want, please reach out to us. Here's our contact information, and we hope you will join us next month. Thank you very much. Take care.